Hi everybody, and welcome to a new episode of Blockchain Central. First of all, please note that this content does neither represent financial, legal, or tax advice, nor is it supposed to be understood or interpreted as solicitation to buy or sell any securities, coins, or tokens. In this video, we'll take a closer look at a well-known cryptocurrency called Bitcoin. Bitcoin serves as a digital currency and was the first to introduce the blockchain technology. Bitcoin is a decentralized peer-to-peer payment network without the need for intermediators. In this course of the video, we'll explain the technology behind Bitcoin, introducing the so-called proof-of-work mechanism, and talk about security, privacy of the network. In addition, we'll discuss the potential of Bitcoin in the future. But let's start at the beginning of the success story of Bitcoin and the blockchain technology. Blockchain is the underlying technology of Bitcoin and was first introduced in a white paper in 2008 by an individual or group called Satoshi Nakamoto. Until today, there are only speculations on a true identity of Satoshi Nakamoto, and we can only assume why they chose to develop this technology. The introduction of the decentralized currency came at a time of financial banking crisis, and many Bitcoin enthusiasts perceived that the cryptocurrency as an alternative payment method outside of the traditional centralized banking system. It is also very interesting to know the very first Bitcoins included a message, which quoted the heading of the Times in January 2009 about the bailout of banks. But besides the speculation on the origins, what exactly is Bitcoin? And how does the blockchain technology work? Bitcoin is a decentralized peer-to-peer payment network, which allows for the worldwide transfer of digital currencies without any intermediators or third parties involved. The Bitcoin network consists of multiple computers, so-called nodes, which run the Bitcoin software and communicate with each other via an open-source Bitcoin protocol. The protocol allows users to transfer Bitcoins between the nodes. Every transaction in the network is stored on the public ledger and so-called blockchain, and each of the nodes keeps a copy of this ledger. If you want to send one Bitcoin to another member of the network, you have to broadcast this transaction to the network. Miners are then verifying this transaction, and after they reach consensus, your transaction is added to their copy of the blockchain. As a consequence, the balance of your Bitcoin wallet is reduced by 1 Bitcoin and the wallet of your recipient is increased by the same amount. The verification prevents double spending of Bitcoins and creates trust among the nodes in the network. Several transactions are recorded one after another in groups of transactions and is so-called blocks. These blocks are then combined in a chronological order on the blockchain. Every miner in the network has a copy of the blockchain and constantly checks the authenticity of the data with other miners. Therefore, it is practically impossible to change past transactions or to verify illegitimate transactions. What is the incentive for miners to provide computing power for the verification of transactions? Miners are competing to be the first to add a new block of transactions to the blockchain. In order to win the race, miners have to solve mathematical problems of a hash function. The miners who solves the problem first can add the new block to the chain and receive a fixed amount of Bitcoin in return. The amount is adjusted roughly every 4 years and is currently at 12.5 Bitcoins. The solution of the hash function confirms the usage of computing power, and the mechanism is called proof of work. This mechanism allows trustless interactions between unknown and anonymous nodes in the system. Therefore, no intermediary or trust third party is required to transfer the digital currency. As mentioned before, every transaction is stored on a public ledger and transparent for everyone in the network, which, of course, raises the question of anonymity and security of the network. Even though details on the transactions like the transferred amount, the Bitcoin address of the sender and the recipient, or the exact time are publicly known, the identity of the person behind each Bitcoin address stays unknown. In addition, the concept of public and private key helps to cryptographically secure the access to every Bitcoin address and prevents the theft of Bitcoins. This makes Bitcoin an anonymous and secure network for peer-to-peer money transfers. If you want to know more about the anonymity of Bitcoin, check out our video on this subject right here. In contrast to conventional fiat currencies like the euro, British pound, or US dollar, Bitcoin has no centralized authority, which issues new units of currency or regulates the supply of Bitcoins. It is the predefined Bitcoin protocol which regulates the supply of Bitcoins. Approximately every 10 minutes, the miners add a new block of transactions to the blockchain, and the new Bitcoins are released, and the total supply of Bitcoins is limited to 21 million. Developers improve the Bitcoin protocol over time, and the nodes in the network can decide to accept the new versions of the protocol or to continue with the old versions. Once the network disagrees on the changes in the protocol, a fork of the blockchain can occur. This means the blockchain splits and separates into two different chains. A major hard fork took effect in August 2017, and the new Bitcoin Cash was created. At this time, everyone who owned Bitcoins owned the same amount in Bitcoin Cash coins. The Bitcoin enjoys great popularity and is still the largest cryptocurrency in terms of market capitalization. By now, the technology has already found its entrance into mainstream media and politics and has attracted many investors. There is, of course, much controversy whether Bitcoin has the potential to replace well-established fiat currencies, but most experts agree that, with blockchain, Bitcoin has introduced a key technology which has the potential to disrupt many industries and to revolutionize the IT world. Already today, many new solutions are built on top of the concept of Satoshi Nakamoto's, and there are more to follow in the future. Bitcoin is also known as the backbone of the cryptocurrency ecosystem. On most exchanges, other cryptocurrency rates are quoted against Bitcoin, BTC, and the exchange of fiat currencies into cryptocurrencies is often realized with Bitcoin. This means that if you want to buy a less popular cryptocurrency, you have to exchange your euros into Bitcoins first, and later exchange your Bitcoins into the desired cryptocurrency. Okay, so what have we learned in this video? Well, first of all, you know that Bitcoin was the first cryptocurrency introduced by someone hiding behind the Satoshi Nakamoto pseudonym, and is based on the blockchain technology. A decentralized system of nodes allows the cryptographically secure and anonymous transfers of digital currencies around the globe. Transactions are recorded on the blockchain, which is distributed around the network. Miners verify transactions with the help of computing power and receive the Bitcoins in return. This consensus-based proof of work mechanism creates trust among the participants and eradicates the need for any intermediaries or centralized authorities. Additionally, Bitcoin has initialized the development of many other blockchain solutions with great potential in the future. Thanks for watching. I hope you liked it and found this overview useful. If you have any suggestions for future videos and would like us to investigate a topic, please leave your suggestions in the comments below. Also, make sure to hit the like button if you like this video, and don't forget to subscribe to Blockchain Central to never miss a beat. Happy investing.